There are rumours coming in that the Bank of England are going to, for the first time in its history, turn to negative interest rates in an attempt to kickstart the economy. We have already seen interest rates go negative in major economies like Japan in 2016 and have remained there ever since. A little closer to home, the current European Central Bank deposit rate is minus 0.5%, the lowest on record.
Over in the US, Trump indicated that he'd be in favour of the Fed adopting negative interest rates in order to compete with other countries who have already gone there. Of course, as with everything he says, this policy has been criticised by key figures such as the CEO of JP Morgan Chase & Co. because the final outcome of the negative interest rate experiments in Europe and Japan is not yet known.
But what does all this mean in plain English? What exactly are negative interest rates and why could rates go negative? Most importantly, how does this impact us as investors and savers, and how does it impact our mortgages and other debts? In this video, we have all the answers to these questions and more. Let's check it out.
Welcome to MoneyUnshackled.com, the investing and finance channel that sets you and your finances free.
I'm Andy, and that was Ben. And if you like what we say, hit the like button and click subscribe.
Investing at the best of times is complicated enough. Robo-investors such as Nutmeg and Wealthify can handle all of your investments for you. And better yet, we have some awesome offers to get you started. Such as 0 fees on Nutmeg for 6 months when you use our link. We've put the link to the offers page in the description below. Now, let's get into the video.
What are negative interest rates? The Bank of England is the UK's central bank, and a central bank's role is to act as a bank for banks. This means that banks will keep their excess money with the Bank of England, and traditionally they would receive interest on these deposits. A negative rate would mean that banks have to pay the Bank of England to deposit money with them, a concept which a few years ago would have been unthinkable.
This interest rate, known as the bank base rate, influences the cost of bank lending throughout the economy because the high street banks use it to determine how much interest they pay to savers, as well as what they will charge people who take out a loan or a mortgage. Lower rates therefore stimulate higher lending.
The base rate has been stuck on or near record lows since the financial crisis in 2009, and people have been saying ever since interest rates can't go any lower. However, since then the bank has cut them to a new low of 0.1% in March 2020, and a negative interest rate is looking ever more likely.
Why turn to negative interest rates? Interest rates are lowered to stimulate the economy, and in theory, lowering interest rates below 0 should have the same effect. But in practice, it's a bit more complicated than that, which is why the Donald was criticised for suggesting it. After all, why would anyone pay to stash their money in a savings account, or pay to lend someone money, when they could just keep their cash at home for free?
On the flip side, it does incentivise businesses and individuals to want to borrow. Most middle-class people are brainwashed from a young age that borrowing is bad, but in truth, that's only half the story. Borrowing is often very helpful as it rapidly increases how fast a business can initiate a project or an individual can buy a house. At lower interest rates, we are less hindered by expensive interest payments and are therefore more inclined to borrow more and therefore spend more and invest more.
Moreover, lower and particularly negative base rates encourage banks to lend out their spare cash. They're desperate to get rid of it so they don't have to pay interest on it. This should make it a lot easier for all of us to access capital.
And thirdly, negative interest rates devalue a country's currency. Yes, the pound can actually get weaker than it already is, which won't be good for your annual trip to Benidorm. When the Bank of England cuts rates, it means assets denominated in pounds yield less of a return, lowering demand for sterling. This means a country's exports are cheaper compared to others, but then it also costs more to buy stuff from abroad.
What are the downsides of negative interest rates? Banks make money on the difference between the cost of borrowing and the cost of lending. Lower interest rates reduce banks' returns on their investments, as they can no longer charge as much interest on the money they lend out. Previously, they could have just offset this by lowering the amounts that they pay to those people that they borrow from, such as normal people who save with the bank. But they cannot so easily pass negative interest rates on to savers, so their margins get squeezed. A struggling banking sector is not what we need right now.
What negative interest rates mean for mortgages, savings and investments? Investments. Negative interest rates will discourage investors from pouring money into the UK. This in theory will suppress the value of stock markets. but with nowhere else for investor cash to go, we imagine this will actually boost stock valuations. Maybe a reason why we have seen very high stock valuations recently.
After all, we certainly won't be putting money into bonds and receiving nothing for it, or worse yet, having to pay the government to lend to them. It's ludicrous. Who in their right mind would pay a heavily indebted government to borrow their money? This isn't just economic theory either. In May, Britain sold its first bonds at a negative interest rate.
Pathetic gilt yields is a key reason why we've avoided bonds for 10 years, and negative rates is a step too far. On the plus side, if you already own some bonds, an interest rate cut should see them appreciate in price. Moreover, lowering interest rates makes borrowing even cheaper. This encourages consumer and business spending and investment and can boost stock prices. Most people foolishly like high stock prices because it makes them feel richer, but we prefer when the prices are low because we can buy more. The last thing we want to do is to be buying expensive shares.
We think that the effect on peer-to-peer lending will be temporarily damaging to the sector until they figure out how to adapt. In order to remain competitive in the market, peer-to-peer lenders will have to lower the interest rates they offer to borrowers. This in turn means that they will offer lower interest rates to the lenders, i.e. the investors, you and us.
Yet, there will become a point when lenders won't want to lend as the risk-reward ratio tips. Neither of us will be lending if we're not fairly rewarded for the risk we take. At a time when defaults are likely to increase, we don't want to be accepting a lower rate of return before defaults are even factored in. The peer-to-peer bonus cash offers on our website is at least some consolation for bruised investors.
Savers! Saving has been a fool's game now for about a decade, but unfortunately, we always have to hold on to some cash. And the older you are, the more you have to hold. And you will be unfairly punished because of it.
Negative interest rates could mean that you are charged to deposit money with your bank, but in practice this seems unlikely, especially if the bank base rate was lowered just below zero, which is probably the most likely outcome.
Some decent research by the BBC found that in countries that have already gone negative, banks were reluctant to pass this on to savers. In Sweden, this was seen as a taboo, and they said competition is fierce and households are ready to move their money to another bank, so nobody wants to lose business.
Swiss banks UBS and Credit Suisse only impose negative rates on deposits of more than 2 million Swiss francs. And as we would expect, in Germany, where some banks impose charges on deposits of more than €100,000, £90,000, some people have started stashing their money in vaults.
If banks did start charging, many people would withdraw their cash, which would just lead to other problems, like increased likelihood of burglaries. Additionally, it could even cause a run on the bank, which is where many clients withdraw their money at once. This can destabilise the bank to the point where it runs out of money and thus faces sudden collapse.
So, it looks highly likely that banks won't charge their customers if they have small deposits with them. In countries with sub-zero interest rates, commercial banks have passed them on to big companies who bank with them. We guess it's not as easy for a big company to store money under a mattress.
Mortgages. Most borrowers are on fixed rate mortgages, meaning that their rate does not fluctuate when the base rate changes. If you're in the market for a new fixed rate mortgage right now, there are some incredibly low rates, with some at just over 1.2% when fixing for 2 years. If the base rate goes even lower, we expect these to get even more tempting. But they almost certainly would not go negative. How mad would that be?
I've just remortgaged my home myself and decided to go for a tracker mortgage. Although it is currently more expensive than the fixed rates available, I am expecting it to track the Bank of England base rate lower. There is, however, a clause on this mortgage that will prevent it from going negative. But nevertheless, that does mean I could end up paying zero interest on my home. That would be cool.
Other debts. Although most debts don't track the Bank of England base rate, the cost of your debt could still come down, as they know that you may have more opportunity to move that debt to a lower interest rate elsewhere. But a drop of 0.5%, for example, is unlikely to make much of a dent if you've already accumulated an extortionate amount of credit card and overdraft debt anyway. Some types of debt are just plain bad.
Question of the day. Are you doing anything to prepare for negative interest rates? Let us know in the comment section. Thanks for watching. On this channel we talk about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is MoneyUnshackled.com. See you next time.